I'm Anthony Valeri, Director of Investment Management in Wealth and Fiduciary Services. Thank you for joining us. It's been a tough year, as everyone knows, for both stock and bond investors. 2022 has been a particular year of upheaval in the bond market with some record-setting historical precedents. But as painful as that year has been, we take a look at the bond market and what the upheaval means for 2023 and beyond. Important to note that the higher yields in the bond market will begin to pay benefits for investors going forward. The decline in bond prices has led to much higher bond yields. The 10-year Treasury yield has more than doubled in 2022, and some maturities have seen their yields more than triple. So as painful as it's been to live through this period, the future looks much brighter. Why do we say that? Well, because yield is a very good predictor of future return. Here we show the 10-year Treasury yield and shifted forward 10 years and compare that to the total return on the Bloomberg Aggregate Bond Index. This is a 10-year annualized return. You can see how closely they track together. Therefore, the yield has been a good predictor of the 10-year average return. Important to note that that's an average return. Some years will be higher, some will be lower, but over that longer term horizon, which all investors should have, it does track closely to the 10-year Treasury yield. And today's yields in the 10-year, close to 4%, suggest that returns should improve substantially from close to zero and from a 10-year basis today. And the same holds true in the municipal bond market. So if we look at municipal bond yields and future return, we also see that close correlation. Here we're looking at a 5-year horizon rather than 10-year, and you can see how the starting yield to maturity indicates the prospects of a higher total return. So the higher the starting yield, the higher the total return after 5 years of holding municipal bonds. And here we're using the municipal 1 to 10-year blend index. All else equal, yield again a good predictor of future return. Let's take a look at what a difference a year makes, and this is what I'd call a tale of two 5-year Treasury notes. Just over a year ago, the Treasury issued a new 5-year with a stated coupon rate of 1.125%. It was issued at a slight discount to yield 1.18%, and that security generated $112.50 of interest income for a $10,000 investment. Fast forward to the current 5-year Treasury issued in just this past October, and look at the difference. The coupon rate is 4.125, the yield to maturity was 4.18, and more than 3 times the interest income on a $10,000 investment. This is a big change, and that added income not only provides a buffer against additional rises in interest rates, but it also provides a higher prospect of better returns going forward. So a big change in the bond market, particularly on the 5-year here. But what about Fed rate hikes? What if the Fed continues to raise interest rates? What will it do to my bond holdings? Well, it's important to note that the bond market has already priced in a lot of rate hikes. Here we're looking at the futures and what's implied in the bond market from the Fed over the coming months. And as you can see, futures indicate that expect the Fed to raise overnight interest rates to 4.9% from a current range of 3.75 to 4%. So roughly 1 percentage points worth of rate hikes are priced into the bond market currently. Now, the Fed could go higher than that. They could take it above 5%, for example, and that could exert some pressure on bond prices. Also, some of those rate cuts you see on this slide for late 2023 and 2024, if they don't materialize, could also pose a headwind for the bond market. But still, the now higher level of interest will provide a buffer, and the prospects for returns are much improved. And again, those Fed rate hikes, much of which are already factored into current prices. So there is light at the end of the tunnel. We'd encourage investors to increase their average maturity to reflect the better value in the bond market and now higher yields. I'm Anthony Valeri. Thanks so much for listening. We'll speak to you again soon.